Welcome to the Deep Dive, where we cut through the noise to bring you the essential insights from the most compelling stories in finance and technology. Today, we're plunging into the quantum realm with Rigetti Computing, Inc., ticker symbol RGTI.
That's right.
This company isn't just playing, it's pioneering at the very edge of computational possibility. They're aiming to build machines that could redefine how we solve humanity's toughest problems.
A really ambitious goal.
Definitely. But here's the burning question we'll unpack. Can Rigetti successfully navigate that, well, colossal chasm between groundbreaking science and sustainable profitability, especially when the promise of quantum advantage still feels years away?
It's a long road.
We're looking at Rigetti as of September 17th, 2025. That's when the stock closed at an all-time high, $21.44 a share.
Yeah, a significant peak.
And by the end of this deep dive, you'll understand why that price point places it right near the upper end of its incredibly speculative intrinsic value range.
So our mission today is, well, to distill the absolute most important insights from our stack of sources.
Yeah.
Give you a comprehensive, almost Blinkist-level understanding of Rigetti.
Right.
We'll be exploring their unique business model, the leadership guiding this ambitious venture, their current financial health, where they stand in this fierce market, the significant risks they face.
And ultimately what it all means for their future.
Exactly. Their future potential.
Okay. Before we dive into the quantum bits and bytes, a quick note from Stock Analytics AI. If you're finding value in these deep dives, please hit that like and subscribe button. It really helps us out.
It does.
Our members, for just $4.99 a month, get priority deep dives on the tickers they care about most. And over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to that incredible library.
That's a huge undertaking.
It is. And if you're interested in just a one-off deep dive on a specific company, just drop us a super thanks.
Simple enough.
All right, let's get into it. We've structured this deep dive into two main parts. First, we'll lay the foundation. We'll cover Chapter 1, Business Understanding Chapter 2, Management Evaluation, and Chapter 3. Financial analysis.
Get the basics down.
Then in the second part, we'll expand our view to the broader landscape. We'll dive into Chapter 4, Market Sentiment, Chapter 5, Ownership Structure, Chapter 6, Risk Assessment, and finally, our Chapter 7, Conclusion.
Sounds like a good plan.
The foundation.
Let's kick things off with Chapter 1, Business Understanding. We've talked about Rigetti standing at the precipice of this technological revolution. But the core question remains, can they truly bridge that gap to profitability?
That really is the crux of it, isn't it? We're scrutinizing Rigetti Computing, Inc., trading on NASDAQ as RGTI, and our analysis snapshot is, as you said, September 17th, 2025, the day the stock closed at that all-time high of $21.44 per share.
So let's dig into their core business. What really jumped out at me from our sources is this idea of being vertically integrated, full stack. For a company in such a bleeding-edge field, that sounds like a massive undertaking. Can you break down what that actually means for Rigetti and, well, why they've chosen that path?
It's a critical strategic choice, yeah. Vertically integrated full stack basically means Rigetti controls almost every single aspect, from designing and actually fabricating their superconducting quantum processors in their own dedicated Fab 1 foundry.
Their own factory, essentially.
Exactly, all the way to assembling the full quantum systems and then delivering that computational power via their cloud platform, Quantum Cloud Services, or QCS.
Okay, and the why? Why do all that in-house?
The why is pretty clear. End-to-end control. It allows for really rapid iteration, quick design changes, and crucially, it safeguards their intellectual property.
Makes sense. Keep the secret safe.
Right. However, this level of control is exceptionally capital-intensive. It demands substantial R&D, massive manufacturing investment, platform development.
So it costs a lot.
A lot. Which leads to a heavy reliance on equity offerings, selling stock to fund their very high operational cash burn.
Okay, that makes sense. So with all that heavy investment, how are they actually bringing in revenue right now? Is there any?
Well, there is some, but it's small. They have two primary revenue streams currently. The first is through their Quantum Cloud Services, QCS. This is basically a platform as a service model. You get cloud access to their quantum computers.
Like AWS for quantum?
Kind of, yeah. It's monetized through subscriptions, strategic partnerships, and sometimes technology licensing agreements. The second stream involves on-premise system and component sales. These are direct sales of complete systems or maybe just individual quantum processing units, their QPUs.
And who buys those?
Primarily really sophisticated customers, think national laboratories, large research institutions, places like that.
Got it. So what are the tangible products Rigetti is actually putting out there today? What can people use?
Their flagship system is the 84-qubit Anka-3 quantum computer that's accessible via their cloud platform.
84 qubits? Is that a lot?
It's significant, but what's really key here isn't just the raw number of qubits, it's their modular approach. Take their 36-qubit Cepheus 136Q system. It isn't just another machine, it crucially validates their unique chiplet-based architecture.
Chiplets, like in regular computer processors.
Exactly the same idea. That's their stated pathway to scaling beyond current limits, maybe hundreds, even thousands of qubits. That's a critical insight for their long-term viability.
Ah, okay. The scaling path.
And for researchers, they also offer the 9-qubit Novera QPU as a sort of plug-and-play component.
And all this is mostly delivered through the cloud.
Largely, yes, via Rigetti Quantum Cloud Services, QCS, and they integrate with major cloud platforms like Amazon Bracket and Microsoft Azure to broaden their market reach, get it in front of more users.
Pretty impressive they're building all this stuff in-house. So where does Rigetti actually fit in the broader market landscape?
They are definitely a pure-play quantum computing company, founded back in 2013, singularly focused on one type of qubit, superconducting transmon qubits. They were a trailblazer, actually, offering cloud-based quantum access as early as 2017. And their Fab 1 facility is a huge differentiator. It's the industry's first dedicated, integrated quantum device manufacturing facility.
So they make their own chips, basically.
They do. And despite being a relatively lean company, maybe 140 to 160 employees.
That's small for this kind of tech.
It is.
Yeah.
But they're recognized alongside tech giants like Google and IBM and other pure plays like IonQ and D-Wave. They're in the conversation.
And what's their core mission? What's the value they're promising to deliver eventually?
Their stated mission is, well, to build the world's most powerful computers to solve problems currently considered intractable, unsolvable today.
Big goal.
Huge. They're focused on a hybrid quantum classical computing architecture. The idea is that quantum acts as a specialized coprocessor for specific, really complex calculations, working alongside traditional computers.
So not replacing regular computers, but augmenting them.
Precisely. And by democratizing access through the cloud, they aim to enable totally novel applications across fields like quantitative finance, drug discovery, climate simulation, logistics optimization, the list goes on.
Okay. Now let's zoom out a bit and look at the broader industry landscape. Because quantum computing, it really is a sector on fire right now, isn't it?
Oh, absolutely. The projections are incredible. The quantum computing industry is expected to grow at a compound annual growth rate, a CAGR, somewhere between, say, 30.88% and 34.6%. That means expanding from maybe $1.44 billion in 2025 to over $16 billion by 2034. Massive growth potential.
And what are the key trends driving that in 2025?
Well, the big one is the pursuit of high-fidelity, error-corrected logical qubits. That's sort of the holy grail right now. Also, the dominance of cloud-based quantum as a service, or COS, increasing focus on hybridization, mixing quantum and classical and software abstraction layers.
Making it easier to use.
Yeah, hiding the complexity. And finally, we're seeing a consolidation of capital, money flowing into fewer, bigger bets in the space.
You mentioned logical qubits there.
Yep.
That jumped out at me. For our listeners, what exactly does that mean, and why is it so critical?
That's a great question. So right now, the individual physical qubits, the basic building blocks, are really delicate and prone to errors. They lose their quantum state easily.
Crazy.
Very noisy. Logical qubits are essentially error-corrected qubits. You build them using many physical qubits working together, along with complex error correction codes. The result is something far more stable and reliable.
Ah, so you can actually run things on them.
Exactly. You can run complex algorithms without the results being completely swamped by noise, achieving high-fidelity logical qubits. That's like the Mount Everest of quantum computing right now. It's the path to truly useful machines.
Got it. And who are Rigetti's main competitors in this high-stakes race to climb that mountain?
The competition is fierce and really diverse. On one side, you've got the absolute giants, Alphabet's Google, IBM, Microsoft. They bring, immense resources, decades of research, and existing cloud infrastructure.
Hard to compete with that.
Very. Then on the other side, there are other pure play competitors like IonQ. They use a different technology called trapped ions, and D-Wave Quantum, which focuses on a specific type called quantum annealing.
So different approaches.
Exactly. And that leads to what people call the battle of modalities. Rigetti is fully committed to superconducting qubits. These are incredibly fast at performing operations, but they need extreme Sub-zero cooling, really complex infrastructure.
Okay.
In contrast, competitors like IonQ use trapped ions. These are typically more stable, they hold their quantum state longer, but they're often slower to perform calculations.
Pros and cons for each.
Definitely. So, investing in Rigetti isn't just a bet on the company. It's really a high-stakes wager on their specific scientific approach. Superconducting qubits ultimately prevailing or becoming dominant.
That's a crucial point.
Yeah.
And just to give a sense of scale, Rigetti's market cap, around $6.2 billion. How does that compare?
Well, it's significant, but it pales in comparison to the tech giants. Alphabet, Google, is a $3 trillion company. IBM is over $160 billion. Even among the pure plays, IonQ, using trapped ions, has a market cap over $13 billion, roughly double Rigetti's. So it highlights the scale of the challenge, but also the potential reward if Rigetti succeeds.
Beyond the tech itself, how does the regulatory environment play into all of this? Is the government involved?
Very much so, especially in the U.S. The U.S. National Quantum Initiative Act provides significant federal funding and encourages partnerships.
Money helps.
It certainly does. But beyond funding, the government is actively shaping the future market, particularly around cybersecurity. NIST, the National Institute of Standards and Technology, is developing new post-quantum cryptography, PQC, algorithms. These are new encryption methods designed to be secure against attacks from future, powerful quantum computers.
Protecting against the threat quantum computers pose to current encryption.
Exactly. And legislation like the Quantum Computing Cybersecurity Preparedness Act of 2022 and a proposed act for 2025 actually mandate that federal agencies migrate to these new PQC standards.
Deadlines.
Yes, with timelines. For example, critical infrastructure systems need to be upgraded by 2027.
So that creates demand.
A huge guaranteed demand for quantum-safe solutions down the line. That's a massive long-term opportunity for a company like Rigetti, developing the very tech that necessitates this change. There are also U.S. export controls on advanced quantum technologies, which shapes the global competitive landscape.
Okay. And what about new players trying to get into this field? Are there significant barriers to entry? Could someone just start a quantum company tomorrow?
Oh, definitely not easily. The hurdles are immense. First, there's the extreme technical complexity. You need expertise across physics, materials, science, engineering, computer science. It's highly multidisciplinary.
Hard to find people.
Very hard. Which leads to the next barrier, a global scarcity of human capital with the right skills. There just aren't enough quantum scientists and engineers to go around. Then there are the prohibitive capital requirements. Building something like Rigetti's Fab 1 foundry, buying those specialized dilution refrigerators that cost millions, it takes enormous investment.
Money and talent.
And finally, there's a formidable intellectual property moat. Rigetti, for instance, holds over 252 issued and pending patents covering its full-stack approach. It's very difficult to just replicate what they're doing.
So given all those challenges in the competitive landscape, what are Rigetti's unique competitive advantages? Let's start with their brand strength and recognition. Do people know them?
They do, within the field, certainly. They've been a pioneer since 2013, got recognized early on by places like MIT Technology Review, and their credibility is definitely reinforced by significant partnerships with DARPA, the Department of Energy, AWS, Microsoft. Those names carry weight.
That early start helps build reputation.
For sure.
Okay, what about cost advantages or economies of scale? Do they have any yet, making things cheaper than competitors?
Currently, probably minimal. They're still very much in heavy R&D and early commercialization phases. However, that in-house Fab 1 foundry that could provide significant future cost advantages. As the technology matures and scales, controlling their own production could lead to an accelerated learning curve, better yields, and ultimately lower costs.
So it's a long-term play for efficiency.
Exactly. That vertical integration is strategic for the long run.
What about network effects or switching costs? Are customers kind of locked into Rigetti's ecosystem once they start using it?
Also minimal right now, I'd say. In fact, the industry trend is actually moving towards hardware-agnostic software layers, meaning software tools that let users write quantum algorithms that can potentially run on different types of quantum hardware, whether it's Rigetti's, IBM's, IonQ's.
So that reduces lock-in.
It does. It generally reduces switching costs for users, which, interestingly, makes Rigetti's unique hardware capabilities and performance even more crucial for actually retaining customers. They have to deliver the best results.
Okay, that makes sense. But they do possess some truly unique assets or capabilities, right? What stands out?
Absolutely. Number one is their patented multi-chip modular architecture. That's really their crown jewel. This uses those chiplets we mentioned to scale their qubit counts first to 100 plus, eventually they hope to 1,000 plus way. That's their explicit pathway to the kind of computational power needed for true quantum advantage.
The scaling secret sauce.
Potentially, yes. Secondly, their vertically integrated in-house Fab 1 foundry. It's a huge strategic asset for rapid prototyping, driving innovation faster than relying on external fabs, and, again, protecting their valuable IP. Control. And of course, it's all underpinned by that comprehensive patent portfolio, over 252 patents covering their entire full-stack technology from chips to cloud.
Let's move on now to Chapter 2, Management Evaluation. Let's look at the people steering this quantum ship. This seems like a key area.
Definitely. And a pivotal event for Rigetti was the appointment of Dr. Subodh Kulkarni as CEO back in December 2022. He actually replaced the physicist founder, Chad Rigetti.
Oh, interesting. A founder departure. Why the change?
Well, Dr. Kulkarni brings a very different background. Over 30 years in the traditional semiconductor industry, his expertise is specifically in scaling manufacturing commercialization. He was previously CEO of Cyber Optics.
So shifting gears from science to business.
Exactly. It signaled a clear strategic shift, moving the company, or trying to, from a purely scientific research focused towards more disciplined execution, towards commercialization, kind of mirroring how the classical semiconductor industry itself evolved.
Makes sense for this stage.
Yeah.
And in terms of crisis response history or maybe proactive financial management, what stands out about Kulkarni's team?
What really stands out is how they proactively managed their finances. They executed a series of quite large at-the-market, or ATM, equity offerings throughout 2024 and into 2025.
Selling stock directly into the market.
Right, including one massive $350 million offering. This was a decisive move to secure their financial future, basically giving them a multi-year operational runway.
So they shored up the balance sheet.
They did. It mitigated financial risk significantly, although naturally it came with the trade-off of shareholder dilution. More shares outstanding.
Right. You know, what really strikes me here, digging through the sources, is their approach to communication transparency and ethical reputation. It seems quite refreshingly direct for an industry that's often full of hype.
I agree. Absolutely. CEO Kulkarni has been remarkably transparent and, frankly, realistic. He openly states that the industry is still 3 to 5 years away from achieving quantum advantage. That's a key phrase, meaning when quantum computers can actually outperform classical ones on useful problems.
Managing expectations.
Exactly. He actively tamps down on expectations for near-term revenue, emphasizing they're still very much in a technology development mode, not really a commercial one yet. They also provide regular, quite detailed updates on their technology roadmap progress on Anka 3 Cepheus 1 fidelity improvements.
So keeping investors informed.
Yes. And crucially, our sources indicate no ethical issues or controversies, which, builds significant long-term credibility, especially in a nascent industry that can be prone to overpromising.
Good point. Okay, let's talk capital allocation. Where is Rigetti putting its money? It seems single-mindedly focused on organic growth, right? Building from within.
That's exactly right. It means heavy, heavy investment in R&D. Specifically, they talk about improving their 2-qubit gate fidelity, how accurately operations between qubits work, and of course, scaling those qubit counts.
The core science.
It's the core science. And also, significant capital expenditures, CapEx, pouring money into their Fab 1 foundry. Upgrading equipment, expanding capacity.
So the financial impact of that is clear.
Oh, yeah. You see it directly in the numbers.
Yeah.
Q2 2025 operating expenses were $20.4 million, leading to a net loss for that quarter of $39.7 million. That clearly demonstrates that high cash burn we talked about.
And they haven't really done much M&A acquisitions.
Yeah. Very limited. Their public debut was via a SPAC merger in 2022. But besides that, the focus is internal growth. Though there is one key strategic collaboration worth noting: Quanta Computer.
The big Taiwanese manufacturer.
That's the one. It involves a mutual $100 million investment commitment over 5 years, plus Quanta made a direct $35 million equity investment in Rigetti. That signals a pretty strong strategic alignment, not just a customer relationship.
Interesting. In terms of returning capital to shareholders, though, share buyback history and dividend policy, it's a pretty quiet picture, isn't it?
Yeah, completely quiet. There's no share buyback program, quite the opposite. They issue shares to raise capital. And there's no dividend paid, nor any plans mentioned to initiate one. All available capital is rigorously reinvested back into the business for growth.
Which is entirely typical, right, for a company at this stage.
Oh, absolutely. Totally expected. You wouldn't expect dividends from a pre-commercial, high-growth tech company burning cash.
Yeah. Okay. And speaking of that investment, their return on invested capital, ROIC, is, well, consistently and deeply negative. Sources show it ranging from negative 13.67% to negative 29.48% DPM. That looks bad on the surface.
It does look bad if you compare it to a mature, profitable company. But for Rigetti, a deeply negative ROIC isn't surprising. Like you said, it's almost expected at this point. You have to think of it differently. For a company on this bleeding edge, every dollar they invest today, even if it shows up as a loss on the income statement or negative ROIC, is essentially a seed being planted.
Seed capital for the future.
Exactly. Seed capital for a potentially massive harvest of future profitable growth if they succeed. It's simply the cost of being a pioneer in a potentially revolutionary field. The entire investment thesis here is predicated on successful commercialization down the line, making today's ROIC less relevant than future potential.
Okay, let's dive into Chapter 3, financial analysis. Let's talk about the hard numbers.
All right, so as of that September 17th, 2025 date, Rigetti's market capitalization was sitting at approximately $6.23 billion.
$6 billion. That's substantial. Puts them firmly in the mid-cap category, right? Even though they're basically pre-commercial.
Precisely, which immediately tells you a lot about market expectations.
And looking at their revenue growth trends over the past 5 years, the numbers are small and actually quite volatile.
Very much so. In fact, their trailing 12-month revenue ending June 30, 2025 was just $7.9 million. That was actually down about 37% year over year.
Down, not up.
Down. It highlights that revenue comes from limited, often lumpy development contracts right now. It's not smooth, predictable commercial sales yet. So the key takeaway, again, is that their $6 billion valuation is clearly not derived from current sales performance. It's entirely based on the market's expectation of huge future potential. That's critical for investors to grasp.
Okay. And looking at their profit margins, gross, operating, net, it's basically a sea of red ink, right?
Yeah, pretty much. All the profit margins are deeply negative, which, again, is expected given the heavy R&D investment and complete lack of economies of scale at this point. Gross margin was actually negative 73.7% in Q2 2025. Although, interestingly, the trailing 12-month figure was positive 40.6%.
How does that work? Negative 1/4, positive TTM.
It likely reflects timing differences in how revenue from long-term development contracts is recognized versus the immediate ongoing costs of operating that expensive Fab 1 foundry. It highlights the sometimes complex accounting for these early-stage, deep tech companies.
Okay, but operating in net margins.
Still significantly negative.
Yeah.
Operating margin TTM was around 976%. Net profit margin TTM was over 2100%. Just emphasizes the scale of the cash burn relative to current revenue.
And that cash burn shows up directly in their free cash flow generation over the past 5 years, I assume.
You assume correctly. Free cash flow has been consistently and substantially negative. High cash burn every year. Just to give you an idea, approximate annual free cash flow was around negative $61 million in 2024, negative $59 million in 2023, negative $86 million in 2022. It's consistently burning cash.
So tens of millions going out the door each year.
Right. Net cash used in operating activities for the full fiscal year 2024 was over $50 million. This consistent outflow just underscores their reliance on external funding, like those equity offerings we discussed.
Okay, let's try to quickly sum up the overall financial picture then, based on those key metrics. The big takeaway seems to be this. While revenue is still negligible, only $7.9 million TTM, and their deeply unprofitable net loss of $164.8 million TTM. Rigetti boasts a remarkably robust balance sheet. That seems to be the key strength.
That's the counterweight, absolutely.
They have over $500 million in cash, an equivalent $571.6 million, and crucially, virtually no debt, only $8.0 million listed.
Almost debt-free.
Yeah. This financial fortress, coupled with an exceptionally strong current ratio of 41.57, meaning tons of short-term assets compared to liabilities, provides a critical multi-year runway. That's essential breathing room for a company still so deep in R&D.
Absolutely critical. Which brings us nicely to financial stability. Their earnings consistency, well, it's consistently negative, no surprises there. No near-term profitability is expected by management or analysts. The net loss actually widened in 2024 to over $200 million. But it's important to note this was primarily due to non-cash charges like stock-based compensation or asset write-downs, not necessarily a worsening operational cash burn. That's an important distinction.
Okay. And to reiterate that balance sheet point, their debt-to-equity ratio is effectively 0%.
Right. Minimal debt against substantial equity. Management has very clearly, and probably wisely, opted to fund operations primarily with equity, not debt. That gives them significant financial flexibility, which is absolutely crucial for a company facing such long, uncertain development cycles, less pressure from creditors.
And, as you'd expect, there's no dividend stability and growth to even talk about.
Nope. They pay no dividend, don't plan to. All capital goes back into the core business. Standard procedure here.
Now for the tricky part, valuation analysis. When we look at relative valuation, like the price-to-earnings PE ratio,
It's useless, basically. It's negative because earnings are negative. Something like neg 28 or neg 29 TTM, common among their pure-play competitors, too. Doesn't tell you much.
but the price-to-sales PS ratio,
Yeah,
that one stands out.
it really does. At over 600 times trailing 12-month revenue, that is exceptionally high. Sky high.
What does that tell us?
It just screams that the valuation is based entirely on future expectations, future hopes, not on current performance at all. The market is pricing in massive success years down the road.
So to try to understand that future potential, we often use intrinsic valuation methods, like a discounted cash flow or DCF model. Can you explain that briefly?
Sure, a DCF model tries to estimate a company's intrinsic value by forecasting all of its expected future free cash flows, the cash the business generates after investments, and then discounting those future cash flows back to their present day value.
Money tomorrow is worth less than money today.
Exactly, because of risk and the time value of money. Now, applying a DCF to Rigetti is highly speculative, extremely so,
Why?
because they have deeply negative cash flows right now, and forecasting when or if they'll turn positive, and by how much, depends entirely on uncertain technological breakthroughs like achieving quantum advantage. So the DCF model we built based on the sources, it's purely for educational purposes. It helps us visualize the kind of future success and growth the market must be implicitly pricing in at that $21 share price. It's not a prediction.
Understood. Educational tool only. And based on this educational DCF model, what speculative intrinsic value range did it suggest?
The model generated a very wide speculative intrinsic value range of $10 to $25 per share.
$10 to $25. That's a huge range.
It is, and that wide range itself really reflects the profound uncertainty we've been discussing all along. Huge potential upside, but also significant risk of failure.
And what were the key assumptions needed to even get into that range in the DCF model? They must have been aggressive.
Extremely aggressive, yes. We had to assume negligible revenue and continued negative free cash flow for the next, say, 3 to 4 years, followed by a period of hypergrowth starting around 2029, maybe 2030. And this hypergrowth is entirely contingent on them successfully achieving and commercializing quantum advantage.
A massive if.
A massive if. Then, after that hypergrowth period, we assume a more modest terminal growth rate of 3.5%, sort of in line with long-term economic growth. But crucially, we used a very, very high discount rate, or weighted average cost of capital, WACC, of 22.5%.
Why so high?
To reflect the extraordinary risks involved here, you have technological failure risk, intense competition risk, market adoption risk, execution risk. All that uncertainty needs to be captured in a high discount rate, which significantly lowers the present value of those distant uncertain cash flows.
The horizon.
Okay, let's transition now into the second part of our deep dive. We'll start with Chapter 4, Market Sentiment. What's the market's general perception of Rigetti right now? How are analysts viewing it?
Well, interestingly, despite the risks and lack of profits, Wall Street analysts actually have a strong buy consensus rating on the stock.
Really strong buy.
Yeah. Their average 12-month price target, according to our sources, hovers around $19 to maybe $19.55. The high target was around $21, the low around $18.
Okay, but wait, the stock price on our analysis date was $21.44?
Exactly. What's fascinating is that the current stock price was actually above even the high end of some analyst targets at that time.
So what does that imply?
It implies that, according to those analysts at least, the stock might have gotten ahead of itself. It suggests potential near-term downside from that peak, assuming you believe the analyst consensus. The market was even more bullish than the bullish analysts.
Interesting divergence. What about the recent news impact and general media tone? Is it all positive hype or is there caution?
It seems to be a bit of a conflicting narrative, actually. You see lots of positive media coverage focused on their technological progress, hitting milestones like 99.5% two-qubit gate fidelity, launching the Cepheus-1 system, announcing partnerships like one with CDACE.
The science headlines look good.
They do. However, you also see more cautious reports when their financial results come out, like the Q2 2025 revenue and EPS miss. But often, the market seems to look past those near-term financials.
Focusing instead on the long-term story.
Exactly. Focusing on that long-term technology roadmap and the ultimate potentially transformative promise of quantum computing. The narrative often trumps the numbers at this stage.
Okay, now for some fascinating market indicators. Let's talk about short interest as a percentage of float. Our sources show it's extremely high for Rigetti.
Yeah, incredibly high. We're talking 51.56 million shares sold short. That represents a very significant 16.21% of the float, the shares available for public trading.
16% short. That's huge. What does that mean?
It means a large number of investors are betting against the stock, betting the price will go down. The days to cover ratio, which measures how long it would take shorts to buy back all their shares based on average volume, was about 1.4 days, relatively quick.
Huh.
But that high short interest makes Rigetti a classic battleground stock.
Battleground.
Yeah, you have the bulls betting heavily on that long-term technological transformation, the massive potential. And then you have the bears focusing squarely on the present-day fundamentals, that sky-high PS ratio over 600, the lack of profits, the persistent cash burn.
You saw a tug of war.
Exactly. And this dynamic, this disagreement between bulls and bears, inevitably drives significant price volatility. Big swings up and down are common.
Okay, let's look at the technical picture quickly. The price relative to the 50-day moving average. Where did RGTI stand?
On our analysis date, RGTI at $21.44 was trading significantly above its 50-day moving average, which was around $15.25.
What does that indicate?
That indicates strong positive momentum in the short and medium term. The stock had been trending up strongly leading into that date.
And what about the longer-term trend, the price relative to the 200-day moving average?
Same story, even more pronounced. RGTI was trading far, far above its 200-day moving average, which was down around $11.45.
So a very strong uptrend.
Absolutely. That confirms a strong and persistent long-term bullish trend was in place leading up to that all-time high.
All right. Let's shift gears to Chapter 5, ownership structure. Who actually owns Rigetti? Who are the major stakeholders?
Well, there's quite significant institutional ownership. Somewhere between 39% and 44% of the shares are held by institutions like mutual funds, pension funds, ETFs.
Okay, who are the big players?
The top holders listed were the Vanguard Group, with about 7.04% of the shares. BlackRock held around 6.73%. The usual suspects, the big index fund managers.
Pretty much. And the significance of that is Rigetti's inclusion in major market indices like the Russell 2000 Small Cap Index and various technology ETFs. This provides a steady, consistent source of passive investment demand for the stock. Index funds have to buy it. Got it. What about insider holdings and recent transactions? Are the people running the company, the executives and directors, buying or selling their own stock?
Insider ownership is actually relatively low. Sources indicated it was around 0.7% of total shares.
Less than 1%.
Yeah. And looking at transactions over the 12 months prior to our analysis date, there was a pretty consistent pattern of insider selling. The data showed 31 sell transactions versus only 7 buy transactions. And many of those buys were related to exercising stock options, not necessarily open market purchases.
So mostly selling. Does that mean they lack confidence?
Not necessarily. It's important to note that many, if not most, of these sales are often conducted under prearranged 10b5-1 trading plans.
Ah, the scheduled plans.
Right. Insiders set these up in advance to sell shares over time, often for personal financial planning, diversification, tax purposes. So it doesn't automatically signal a lack of confidence in the company's future prospects. But it does show that insiders weren't aggressively adding to their positions on the open market at those price levels. They weren't backing up the truck, so to speak.
Okay. And what about the overall ownership concentration? Is there a single entity or maybe a small group that holds a controlling interest?
No. Based on the data, it appears to be relatively diffuse ownership. No single entity holds a clear controlling stake. This means that, effectively, control rests with the board of directors and the executive management team, who are ultimately accountable to a diverse group of public shareholders, including those large institutions.
Next up, Chapter 6, Risk Assessment. This feels particularly important for a company like Rigetti. Let's run through a SWOT analysis looking at their strengths, weaknesses, opportunities, and threats.
Sounds good. It's a useful framework here.
Let's start with the strengths. What does Rigetti have going for it internally?
Okay, key strengths. First, that proprietary technology, particularly the patented, potentially scalable multi-chip architecture. That's a core asset. Second, their vertical integration. Having the in-house Fab 1 foundry allows for rapid innovation and IP protection. Third, that fortress balance sheet we discussed. Over $570 million in cash with virtually no debt provides a crucial safety net. And fourth, experienced leadership, particularly a CEO with a proven track record in scaling semiconductor manufacturing. That's relevant experience.
Okay, solid strengths. Now for the flip side, the weaknesses. What are the internal challenges?
Well, the big ones are pretty obvious by now. They are essentially pre-revenue and deeply unprofitable. Minimal actual sales, significant net losses.
Right.
Connected to that is the high cash burn rate. Consistently negative free cash flow means they need constant funding, which leads to the next weakness, persistent shareholder dilution. The business model, for now, relies on issuing new equity to fund operations.
Watering down existing shareholders.
Potentially, yes. And finally, that long and uncertain technology timeline. Management themselves say quantum advantage is likely 3 to 5 years away, and that's not guaranteed.
Okay, now let's look externally. What are the opportunities Rigetti could capture?
The opportunities are potentially massive. First, the sheer market growth. That quantum computing industry projected at over 30% CAGR is enormous potential.
A rising tide.
Could lift all boats, yes. Second, strong government support, particularly in the U.S., through funding and strategic initiatives like the PQC migration. That creates a market. Third, the potential for groundbreaking new applications in AI, finance, medicine. If quantum computing delivers, it could unlock entirely new industries. And fourth, strategic partnerships like the one with Quantum Computer can provide capital, expertise, and accelerate development or market access.
Huge potential upside. But there are also significant external threats, right? What keeps them up at night?
Oh, definitely. Number one is intense competition. They're battling not just tech giants like Google and IBM with near-limitless resources, but also other well-funded focused pure plays like IonQ and D-Wave.
Crowded field.
Very. Second is the threat of technological obsolescence. What if a competing modality, maybe trapped ions, maybe something else, entirely proves superior to Rigetti's superconducting qubits? That's a fundamental risk.
The battle of modalities risk.
Exactly. Third is valuation risk. That lofty multi-billion-dollar market cap is built on hope. It's highly vulnerable to shifts in market sentiment or any stumbles in execution.
So a rug could be pulled out.
It could. And finally, broader macroeconomic and geopolitical headwinds. Things like rising interest rates, inflation, global trade tensions. These can impact any company, but especially a cash-burning tech firm.
Let's touch on those macro factors. How specifically do things like higher interest rates impact a company like Rigetti?
Higher rates hit companies like Rigetti particularly hard for a couple of reasons. First, they increase the cost of capital. If Rigetti needs to raise more money in the future, it could be more expensive. Second, and perhaps more importantly for valuation, higher interest rates disproportionately harm long-duration assets.
Long duration?
Yeah, companies like Rigetti whose big potential profits are expected far out in the future. Higher rates increase the discount rate used in valuation models, like our DCF, which significantly reduces the present value of those distant future earnings. It makes the future less valuable today.
Got it. And inflation.
Persistently high inflation could also be a problem, increasing their costs for specialized equipment, materials, and retaining that scarce quantum talent. It could squeeze their R&D budget and accelerate cash burn.
Okay, and what about specific geopolitical factors? Our sources mention potential U.S. tariffs on semiconductor and chip imports being considered in 2025. How might that affect Rigetti?
Well, on the surface, tariffs on imported components could increase Rigetti's operating expenses if they rely on any foreign suppliers. And reciprocal tariffs from other countries could potentially hinder their international sales efforts down the line.
So, a negative.
Potentially. However, there's a fascinating potential strategic opportunity here as well.
Oh.
As a U.S.-based, vertically integrated company with its own domestic fab, Rigetti aligns extremely well with potential America First industrial policies or national security concerns around critical technologies like quantum.
Being domestic could be an advantage.
Exactly. This could lead to preferential treatment for government contracts, boosted R&D funding, or even being actively championed as a national asset in the quantum race. So the geopolitical angle could actually cut both ways, potentially providing a strategic advantage that outweighs direct cost impacts.
All right, we've covered a lot of ground. Let's bring it all together in Chapter 7, Conclusion. Let's synthesize our findings, starting with a summary of the key bullish points. What's the bull case for Rigetti?
Okay, the bull case boils down to this. Rigetti is positioned as a technological leader in the promising field of superconducting qubits. They have deep intellectual property, that potentially scalable, patented multi-chip architecture, and their own fab. They're operating in a massive potential growth industry, quantum computing, with projections over 30% CAGR, and the ability to disrupt multi-trillion-dollar sectors eventually.
Huge market potential.
Huge. They also have that fortress balance sheet, over $570 million in cash, virtually no debt, giving them a crucial multi-year runway to execute their plan. And finally, their technology and approach are validated to some extent by strong partnerships with major players like Quantum Computer and backing from key U.S. government agencies.
Okay, that's the optimistic view. Now let's summarize the key bearish points. What's the bear case against Rigetti?
The bear case centers first and foremost on the extreme valuation. A multi-billion-dollar market cap on negligible revenue, leading to that PS ratio over 600. It prices in perfection.
Very expensive bet.
Very. Second is the long and highly uncertain timeline to profitability. Management themselves point to 3-5 years just to reach potential commercial viability, quantum advantage, and that path is fraught with technological and market hurdles. No guarantees. Third is the intense competition we discussed. Battling tech giants and other well-funded pure plays means the margin for error is slim.
Can't afford missteps.
Exactly. And finally, the persistent issue of shareholder dilution. Their current funding model relies on issuing new stock, which can potentially erode returns for existing investors over time.
Okay. So if we quickly revisit our valuation summary, that educational DCF model gave us that very wide, speculative intrinsic value range of $10 to $25 per share. Just reminding everyone of the uncertainty.
Right. And that leads directly to our concluding outlook. The current share price, as of our analysis date, was $21.44. That trades near the upper end of that already wide and highly speculative intrinsic value range.
So not much room for error priced in.
Very little. It implies the market, at that point, had already priced in a significant degree of future success, anticipating that they navigate those hurdles and achieve their ambitious goals. This makes it, without doubt, a very high-risk, high-reward proposition. Success requires near-flawless execution on an incredible ambitious technology roadmap over many years.
Who is this stock for, then?
Really, it seems suitable only for investors with a very high tolerance for risk, a deep understanding of the technological challenges, and a truly long-term investment horizon, willing to potentially wait many years for the thesis to play out if it does.
Okay. Before we wrap up, here's a provocative thought for you, our listener, to mull over. Considering that battle of modalities, we discussed superconducting qubits versus trapped ions versus other approaches, how much of an investment in Rigetti is truly a bet on the company itself, its execution, its specific IP, and how much is it actually a high-stakes wager on a specific scientific pathway, superconducting qubits, that may or may not ultimately prevail as the dominant architecture for quantum computing? Something to think about. That wraps up our deep dive into Rigetti computing. Wow. What a fascinating high-stakes exploration into a quantum pioneer. If you found this valuable, please do us a favor and like this and subscribe to Stock Analytics AI. It really helps support the channel.
It does indeed.
Remember, our members, for just €4.99 a month, get priority deep dives on tickers they request, and we're covering all S&P 500 stocks soon with exclusive member access. And for a one-off deep dive on a company you're interested in, just leave us a super thanks.
All right. And just as a final crucial reminder, this analysis was generated by an AI system using the sources provided. It's intended for educational and informational purposes only. It should absolutely not be considered financial advice. We strongly encourage you to conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Do your own homework.
That's for sure.
Thanks for joining us on the deep dive. Keep learning, keep exploring, and we'll catch you on the next one.